All right, $120 billion have flown into ETFs this year. We have Bruce Bond, CEO and founder of Innovator ETFs. Bruce, explain to me what your product is, how it works.
Okay. Well, we have two products that we launched today on the New York Stock Exchange, or yesterday actually. One is the emerging market buffered ETF, and then another one is the developed markets buffered ETF. That's for the MSCI EFA and MSCI emerging markets. Now what they do is they're really simple. You can buy those markets with a 15% buffer. That is, so if you bought it and the market was down 10%, you would be within the buffer, so you'd be protected from those losses. So for the first 15% down in either the emerging markets or the developed markets, you would have a buffer, and so you wouldn't sustain losses if it's down. And then there's a cap on the upside, so you only have a certain amount of the performance. One's about 10 and the other one's about 9.
Now explain, you pretty much just did, explain the competitive advantage, but I asked that because you do have a cap on the upside. So explain to me, is there some investor anxiety? Why are you so competitive with this product?
The reason the cap is there and the reason it's so competitive is there's a lot of people that want to be in developed markets or emerging markets, but they're afraid to do it because of the risk associated with that. What this allows them to do is to invest in those markets, and for the emerging market, they get the first 9% up in the market, but they have a 15% buffer on the downside. So they get that exposure that they need, but they also have the buffer there to provide additional protection on the downside. And then same thing on the developed markets. You know, they have a buffer, but they get 10% of the upside on the developed markets.
And you mentioned this you really do cater to the conservative investor not looking to beat indexes by a whole lot.
Yeah, I mean, what this does, it's like if you bought the MSCI emerging market, you're going to get the return of that. If you bought the developed markets, the EFA, you're going to get the return of that. What this does is it takes both of those. It's going to give you the return of that index over a year, but it's also going to give you that buffer on the downside. And I think that's what a lot of people are looking for. And also what people like is they don't want to just put their money in and say, well, let's see what happens where the market goes. They like knowing, okay, I have a certain amount of buffer and I'm going to participate a certain amount on the upside. They know their outcome in a year based on what the underlying index does. And that gives them a lot of comfort. They're like, okay, I don't just have to hope, the market goes up and I make some money.
Now, I got to ask you, I noticed you've got S&P 500 funds, you've got MSCI funds. There's no euro. When are you going to add a euro?
Well, we're definitely in talks on some of that and what will make sense there. In Europe, they use these types of structures a lot to invest, but really this is the first ETF available anywhere on the globe that actually have the built-in buffers to provide this downside buffer for people.
All right, thanks a lot, Bruce.
Thank you.